My goal with this video is essentially to consider what would I do today if I had to start all over. Let's say, starting from zero. Got to go get a job. I got to rebuild everything from $0 to $1,000,000. How would I go about it? And so that's what we're going to lay it out. I'm going to draw diagrams. We're going to talk about things. We're going to use financial calculators. It's going to be long, boring. It's going to be my least watched video of all time because I want to prove a point that when you do actually give what most people would consider probably pretty sound conservative advice, people get tuned out because they're bored. So anyway, here we go. Let's get it on, baby. All right. So what the hell do we do? We're starting from zero. We're trying to build a financial foundation that can grow to wealth building over long periods of time. And also, of course, there's many markets and ways to do this. I'm just discussing kind of how I would do it based on my experience and what I've had success with. Not the only way that you can do things, a million other ways to do things. Some of you guys might even go on that debt train where you borrow money until you're dead, owing billions of dollars. And yeah, sure, whatever, you do your thing. That's not for me and my family. So if I were to start over, number one thing I would do was obviously, let's just assume you have an income. Let's assume you make, I don't know, 60K. Right? We're making 60K a year, pretty standard. I think average American, I don't know. I think that's pretty much standard right now. I don't know. Depends on where you live. First thing I would do is make a budget. Boring, extremely crazy. I will tell you this. I've had a quantified budget, a very exacting budget for the last probably 15 plus years, where I list every single source of income and I list every single expense that I have, whether it's recurring, monthly, annual, car maintenance, gasoline. I list every single thing that I expect to spend in a month as a line item. I list every single investment account, every single savings account. I have probably in the ballpark of 10 different types of investment, savings, high yield savings, money market, blah, 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 checking, blah, whatever, business accounts. I have tons of accounts, right? So you're listed all out there. You know exactly which ones are coming in, exactly what's going out. So the number one thing is you set a budget. Why you set a budget? Well, the budget is there so you can identify exactly how much money you have when it's all said and done. Do you have a positive number or do you have a negative number? If you have a positive number, then you obviously have enough money left over to then consider going into other things, other investments or savings accounts. If you have a negative number, you have to do one of probably two things. You have to either increase your income by taking on a second job or a third job or doing gig work or asking for a raise or transferring to a company that pays you more. You have to find a way to either increase your income or decrease your expenses, lower your expenses, cut things out of your life you don't need, reduce your electric bill, I don't know, whatever, right? If you have credit cards, whatever, again, we get too deep. You can get really deep in this, and that's why personal financial advice is for a person. After knowing their full financial picture, you make plans for that individual. And since I don't know any of you, this is not specific financial advice. It's just general broad stuff. And we're going to start broad, and we're going to work our way down to the more stuff, deeper stuff. Okay. So very first thing is I'd set a budget so I know exactly how much I'm spending. Now, we've got the budget out of the way. Budget, we don't need to talk about it. If you need help figuring out how to make a budget, hell, I might just make a fake spreadsheet for the channel members and just throw it up there and you can just copy and paste it and put in your own numbers or something. Okay. So here we go. Now let's just say the budgeting is out of the way. We've got ourselves to where we have a positive cash flow at the end of the month based on our income and our expenses. So what I would do then is the very first thing I would be looking to do is to build an emergency savings account. Okay, well, very first thing I would do is make sure I paid off all of my consumer debt. So any credit cards, any, whatever, divide it by 4-month pay plans or all that crap, all that stuff is literally stealing from you. For instance, if I had, here's a financial calculator. Let's say my initial investment was $0 and let's say I'm paying $250 a month for 5 years for, I don't know, some credit card bill or some car or something like that. And let's say I'm 9% interest is what I expect to earn. So in 5 years, right? If you got rid of that expense, again, this is no guarantee of future, blah, 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 blah. you're basically $18,000, right? So that's why if you were to get rid of this bill that's costing you $250 a month for 5 years, it's equating to basically an $18,000 investment over 5 years. So you want to get rid of those things. You do not want to have debts. You do not want to have, and I'm not even talking about the fact that you're paying off credit and not principal. And these things go actually more like for 10 years, right? And then 5 years if you're paying off the minimums, etc. But you can see here, based on averages, you're losing a ton of money by putting your money into debt and not putting it into your own accounts, your own investments, your own savings. That's the number one thing I would do, is pay off all of my debt to make sure that I am fully debt free as much as possible. Now, you might have a house payment or whatever. I get it. You consider that almost like a savings account, because in a way, over time, you're paying down the principal, you're earning equity in your home. And then when you go to sell your home or something, you have that equity. So it's kind of a little different. But anyway, so the number one place that I would be putting my money after I've paid off my debt, I've set my budget, and I know that I have a positive cash flow at the end of it, the very first place we would be going is an emergency savings account. How do I do this? What's going on here? Give me a second. Emergency savings. Okay. And what I want probably for my emergency savings is about $1,500. Now, I've heard a lot of you guys say that you feel like you use gold and silver as your savings account because you're not a good saver. And if you have money in an account, that you'll spend it because you have a hard time keeping money in an account without spending it. So you convert it to gold and silver as a way to save your emergency savings account. I understand that, but for me, I don't like that, simply because you become beholden to the volatility of the market as well as the exchange. So for me, my first $1,500, I would just, if this took 10 months, if it took 2 months, if it took a year, it doesn't matter. This would be my first bucket that I fill and I keep full. Emergency savings account. Why $1,500? I don't know. You got a car transmission issue. You got whatever. You know what I mean? You wreck. You get sick for a week at work. Whatever it is. It's $1,500. All right. There we go. All right. Now, when this cup runneth over, where does it go, right? Like let's say now we've gone on, we're still maintaining everything. We're still back here at this whole, our emergency savings account is still at $1,500, and we still have that extra income at the end of every single month that we need to know where to put it. Okay. So again, I'm telling you, if you guys want real financial advice, I'm going to give it to you. It's going to be boring as all hell. All right. Don't get mad at me that it's boring. All right. So the next bucket I would go to fill after my first bucket starts running over. I think we need a little bit of a visual effect here. We need a little bit of a money spilling over the top of the emergency savings bucket. There you go. There you go. Money is spilling out of the top. Okay. We're beyond $1,500. There's no point in considering you stick this money in there. Oh, and by the way, what would I put this money into? All right. This money would be this money right here for me would not be in gold and silver, would not be in the stock market, would not be in a money market account, would not be in a CD, anything like that. I need it now, right? This money for me would be in what's called a high yield savings account. Okay. It would not be in my primary bank checking or savings account. It's not in your primary bank because your primary bank probably sucks. They're probably paying you 0.5 to 0.1% interest on your money, whereas a high yield savings account is probably paying you closer to 3.5%. So, 3% plus is probably fine. And the other reason why you have this in an external account is because it makes it even less likely that you're going to actually spend your money that's in there. It keeps it as a savings account. When it takes a day or two to transfer or 3 days to transfer, whatever it is, that is kind of a protection from you having quick access to it. You don't give yourself any debit cards with this thing. You don't give yourself any way to access it other than a direct transfer from this account to your primary checking account, and you just don't ever do it. Okay, makes sense? You just leave it in there. It's there for an emergency only. And emergencies are not like, I need an oil change coming up. That's not an emergency. That's a planned expense. You can pull out money for that ahead of time, right? So again, boring as it comes, but we're going to go through it because I think this is more important than anything else. And we'll get to gold and silver eventually if you care about that. All right. So cup runneth over on my primary emergency account here, right? That's great. So now what am I going to do? Well, depending on my job, right? If I have a job that is very, very, very secure, I might only want like an additional 3 months of expenses savings account. And if my job is very secure, maybe I go to 6 months right now. Okay. All right. So this is going to be, oh, wow. Look at this. Is fun, right? This is emergency savings number 2. This is for like unemployment or catastrophe, right? This money I'm going to put in either like a money market or an investment account that is going to be like just blue chip conservative investments. Probably something paying a high dividend, like a 3 to 5% dividend, something that could grow with valuation, could grow. But I'm just going to put this money in. It's going to be 6 months. So for 6 months, let's say my expenses are $4,000 a month. So if you wanted 3 months, it would be 12,000, right? To 6 months would be 24,000, right? So somewhere in that range. You do you. I don't know your life. Anyway, you do. So wow, that's extremely boring. So you mean to tell me that before you're doing anything else, you're basically just saving money so that if a catastrophe happens, you don't lose everything that you've bought after this cup runneth over, right? All right. So we're real boring. This is real boring life. This is, you're just making dinners and you're going to work and you're putting money into accounts and you're just doing nothing and you're going to sleep and you're waking up and you're eating breakfast and taking a shower and you're going to work and you're putting money back in. That's it. Real boring, nice, fun stuff. Now, what happens when this cup runneth over? Right? All right. So we're going through here. Now, this money is invested. Just to be clear, this was actually invested because I'm trying to basically, with this money, I kind of want to get, if I can, a better return than the high yield savings account. So this money is invested. This is in some sort of like, you can put this into CDs if you want, whatever you want, but this is investment account, whatever, bonds or CDs, whatever you want, whatever you're comfortable with. Everybody's got a different thing. And my goal is probably going to be around 4%. That all depends on what the current inflation rate is, but that seems to be kind of fair balance right there. There we go. All right. Now we are to the point now where maybe we're, I don't know, maybe we're 3 years down the road, 5 years down the road. Man, this is fun. Aren't you guys liking financial advice? All right. So now we're like 3 to 5 years down the road. We're still making the same salary, but over time we have, again, lived below our means. We've saved money. Maybe we've taken a couple side hustles here or there, made a couple grand, this month or a couple grand next month, whatever. We're all just doing our thing, making some money. Yeah. And, over time, we're just, we're there. We're still living kind of debt free, just besides maybe our mortgage. Now, where would I go here? Obviously, you've got your primary home as like a source of your quote unquote net worth, but you're not really putting money into it. It's considered part of your budgetary expenses. So you're still growing your wealth and your net worth through your primary mortgage, equity, but we're not really considering it directly for this demonstration. So now where would I go from here? For me, now, this would be actually, it's probably in parallel. In parallel with the emergency savings, you're probably tapping into some sort of retirement account through a 401k through your work, if possible, or a SEP IRA if you're self-employed, something like that, right? So let's call this retirement investments. All right. Oh, that's ugly. Retirement investments. Here we go. So this could be your 401k, it could be a Roth IRA, it could be, and if you don't know, 401k is just basically an employer retirement, like it's your retirement account. Basically translates to a traditional 401k is a traditional IRA, a Roth 401k can go to a Roth IRA, same type of accounts in general. The big thing is I would give up to the employer match. So if the employer match is 4%, I would give 4%. I would get my full match because that's free money, right? That is free money that your employer is giving you on top of your salary. So I would go up to my employer match. Why let's exit this one out. Let's change this. And then otherwise I want to do here. This will be like the Roth IRA. Okay. Why I don't go all in on the employer account is because, one, employer accounts typically have less mutual fund options for you to invest in. You have a little bit more loopholes to get your money in and out and transferred. There's typically fees that are spread out amongst all the employees. And again, I just go up to the employer match. Once I've gone up to the employer match, right, that's when we start our other bucket. So let's say now I'm still living. I got my 4% going into that. All this bucket is full. All my emergency savings account. I'm living pretty comfortable life right now. To be honest with you, you're probably living pretty comfortable. Best advice I ever got was to automate it before you see it. I have my paycheck going to 3 separate accounts before it even hits my account. Rural stacker, 100%. 100%. I have almost all of my money rural, and I'm going to get to that. That's part of the budget, right? When you have your budget, you're automating your budget. You're automating all your budget and your expenses, correct? So through that automation, you never have to touch it. You don't ever have to make the cognitive decision of where your money's going to go. You're paying everything down. You're putting your money into your savings accounts. You're putting your money into your investment accounts. You're putting, it's all done before you can even screw it up. And then the brilliant part about that, guys, if you do that, then any cash left over, you can spend it on anything you want, and you don't have to worry about it because every single other debt obligation and investment obligation is taken care of. It's the beauty of the system. You literally don't have to think, because if you have $1,000 left over, you could go on a cruise, you could go to a fancy dinner, you could do whatever you want with it, and you have no guilt because you know for a fact you've already taken care of every single other thing, and you're already growing your wealth, and you're already putting all your investments away, and you can just go live life and enjoy it. People don't want to take the time to get to that position. That's the problem with this country, and I've noticed. Anyway, all right. So we've got our 4% match. Now, where would I go? I would go then. Next, I would go into my own individual accounts. So this would be just an investment account. Roth IRA, if you want like a good tax deferral system. Roth IRA has limits though, so I think it's like 7K right now or something like 6,500, up to the max per year. You could do that. You could just do it in a brokerage account. All right. And I would give a percentage of my money away. Maybe it's like 5% or something like that. Again, your percentage is going to be based on you, but whatever. You got that going on. Okay. So again, pretty basic stuff. Now, why, Dragoon, would you choose stock investments at this point over, say, gold or silver or collectibles or antiques and stuff like that? So a lot of it is liquidity, the ease of getting your money converted back to cash, which you need to spend on goods and services. Some of it is time horizon, historical time horizon, right? The S&P 500, for instance, if you just were interested in the S&P 500 since like what, 1957, okay? Since 1957, this thing has averaged, after you take in all the dividends and everything like that, has averaged over 10% returns annually. So if we go back over here, right, if I go back to my financial calculator, and let's just do a very simple little excursion here, right? Let's just say I started with nothing, and I'm putting away $500 a month. Like, let's say this is your employer contribution, your match, and blah, blah, blah. It's probably going to be more than that. And I did this for 30 years, and okay, I don't even want to put 10% on there. Let's say interest rate variability of 1. If you guys don't understand, this is a free calculator, by the way. Investor.gov/financial tools calculators. If you just search compound interest calculator, you can find this thing. Very great tool. I use this all the time. I use this in client demonstrations. I use this with my own money all the time to see where I'm going to be. Anyway, 9% is under the historical average. Okay, we're going to give a variation of 1. So this means we'll get a demonstration of 10 and 8 and 9. Okay, we want to compound annually. We hit calculate. Okay, this right here, this very simple strategy. Again, this is not a guarantee. This is not a guarantee of what will happen if you do this for 30 years. Estimation based on history. Okay, the historical average. All right. So if I just simply put $500 a month into this account and it were to gain 9% annually, that's it, just 9%. I don't have to be a hero. I don't have to go crazy. I would end up after 30 years with $817,840. Now, yes, I understand inflation exists, yada, yada, yada. Okay. Great. Okay. So maybe some years you get 11 or 16%. Maybe some years you get 5% or negative 10%. Whatever. It's an average, right? So how many of you, right, have some sort of expense between credit cards or your F-250 Super Duty or whatever you got that's over $500 a month? The idea here is that this is just basic systemic things that you can do. It grows, it grows, it grows, it grows. You don't even have to think about it. You can put it into, again, I cannot tell you specifically what you should put it into, but there are things out there like the SPY, there's Vanguard's S&P 500 tracker that has very low fees. And essentially what you're looking for is an exchange rate. You're looking for a low exchange rate These are the spiders for SPY. But when you go in here, you'll see. Let me see if I can see more detailed here. They have an expense ratio, is what I'm trying to show you. I don't see it popping up here, but anyway, all of these ETFs and funds and stuff have an expense ratio. Essentially, you just want to find the one that with the lowest expense ratio. It's probably going to be Vanguard, to be quite honest, but just search them all. Find one that tracks the SP 500. It has the lowest expense ratio, so you get the maximum amount that you can out of it. And bam, wada bing, wada boom. All of a sudden, look at that. Wow, 30 years later, you have $817,000. It's great. Wow, right? So, okay, you have $1,000 truck payment. So here you go. Let's do the $1,000 truck payment for, you're not paying it for 30 years, but look, you have all of a sudden you have 1.63 million. So it's just like, anyway, the reason for me that the stock investments are my number one for me is that it's like almost like a set it and forget it toaster oven to me. Okay, I don't have to think about it. Now, after this, if you can do it, I would go into, this is where kind of we have a little bit more, for me, freedom. This is this is where I would go to point where I'd say, okay, what do you like? Do you want to be a landlord? Do you want to have a lot of rental properties and a lot of doors or units? You could go into that, right? This is where you diversify into, maybe you know, at this point now your cup is runneth over so much. At this point, it doesn't matter, right? Like you're living pretty healthy. You've got a pretty good nest egg. In my mind, I can almost set it and forget it on this stuff right here, right? This is like, I'm setting up my retirement accounts, which can, give me benefits and taxes, especially the Roth IRA. I'm going to do a whole video if you guys want. I'll do an entire video on the different types of retirement accounts and why some are better than others and the benefits of some versus others and why, blah, blah, blah. But anyway, starting young is obviously the key here. But if you're older, there's makeups, there's, all sorts of things. Anyway. So now our cups just keep running over. And what happens? Like, let's go back and talk about, well, what happens if I do have an emergency during this, 10, 15 year period that this is going on? Okay. So what I would do then is, let's say I had an emergency and it caused, I had to deplete my $1,500. What I would do then is I would stop everything else. Okay. I would stop everything else. I would stop my secondary emergency savings. I would stop my retirement account. I would stop my brokerage account in reverse order, right? To get back to that $1,500. So if I was putting $500 a month in my investment account, individual account, and if I was putting $500 a month, let's say in my retirement accounts, that's $1,000, I would stop doing that for 2 months. I would replenish my emergency savings account back to $1,500 as fast as I possibly could. Then when it's back to $1,500, I would go back into setting up my company match retirement account, because that's just free money, duh. And then after I got that set back up and I felt good with where I was at with cash, then I would go back and I'd reset up my individual investment accounts. Is this, if you're not, I'm trying not to pay too much attention to the chat because I don't want to get too sidetracked, because it's easy to get off topic. But I hope that's making sense for you. It's just you kind of work your reverse order. And now as we keep going, what you're going to see is, for me, again, this is my plan and what I would do. You will see that I might start taking more and more risk with my money in attempts to get higher and higher rewards or, returns with the risk that I'm taking. So maybe down here, maybe when I'm getting now, I've got my, what I would consider my stable basic accounts taken care of, right? I have my, my expectations of what I think that my stock investments might do over 30 years. So now for me, I'm like, okay, for the next 15, 20 years, what am I going to do with money that's left over after all that's taken care of? And I would hope that after this 15 years, your income's probably gone up from 60K to, I don't know, 80K or 100K or 200K, depending on what kind of industry you're in. I would assume that you've had some growth over 15 years. Like, even if you grew your salary 5% a year, right, you're still pretty high up there. So also there's a quick thing called the rule. So the HSA account, right? The health savings accounts are ways that you can invest inside of money that you can use for medical expenses and stuff like that, which can help save your bacon on, emergencies and medical emergencies. Yes, I'm not digging into every single type of account out there. I'm just kind of going through a basic, how would I go from 0 to $1 million if I had to start over today, right? Again, another one, a big one that a lot of people don't want to do because it takes a lot of effort, is it's really increasing this building multiple sources of revenue, whether that's side gigs or taking on 2 jobs, a morning job, night job, doing, ride share services like Uber and Uber Eats and whatever the other DoorDashes and all that stuff, Instacarts. There's a million ways to make money. You can do, eBay selling. You could, whatever. You could make a product on and sell it on Etsy. There's like a million ways to make money these days because of the internet. But what I would do is I would have my base salary that left me with comfort, with health insurance, vacation time off, employer match 401k. I would take those basic things and then I would branch off of there and then find other ways to build income around that, right? All right, so here we go. Beyond that, so now we're back down here and now we're cooking, right? So now here's what I would do. I would start or buy a business, right? Okay. I would purchase rental or investment property. Investment property would be something that maybe it's a distressed property that I know that I'm buying it in a decent neighborhood, but the house is all run down. So I'm going to put money into it and then I'm going to resell it for, 20, 30% profit or something, right? Started by a business, right? Obviously a lot more risky, but let's say I put down a $50,000, down payment for a $500,000 loan. I buy some sort of car wash or something, and then I rebuild it, and fix it up and clean it up. And then, hopefully generate income that is going to be able to pay my debt to the lender at a higher rate than which I owe. And therefore all of a sudden now it's a cash flowing positive business that I've bought. And then I run that. And then over time it pays off the debt and then blah, blah, blah. And then obviously by increasing the revenue from the business, now I've increased its value and I could resell the business a couple years down the road to somebody else or keep the business if it's generating enough cash flow and I have a good positive outcome forecast, right? All this stuff goes in here. Maybe I look at crypto, right? At this point, it would be maybe I consider crypto. Maybe I get into fine art or collectibles or antiques or, right? And the idea here is you're putting your money into subsidiary things. Now, many of you guys are like, Dragon, you have not even mentioned gold and silver. Let me explain why. Okay. I understand what the gold and silver chart looks like today, but go back and look at the gold and silver chart 5 years ago. Okay. I don't even have 5%. My first goal with gold and silver is to get to 5% of my wealth into gold and silver. Primarily gold, though. Primarily gold is what I'm focused on, but 5% gold, silver. So if I have $1 million, what's that? $50,000. So gold one would be 50K in it would be all right, $1 million, yeah, 50K. So $50,000. Let's say if I were trying to get $1 million, I would want $50,000 in gold and silver. And again, the reason is for me, this would be a hedge against banking failure. Potentially an inflation hedge. However, history has shown that gold and silver are not always inflationary hedges. There are many years where gold and silver net go down that year. Guess what, guys? If gold and silver go down 10% in 1 year, that did not hedge against inflation because I guarantee you inflation did not go down 10%, right? So if we're looking historically, gold and silver were safe haven assets that didn't move much, that kind of just kept up with inflation and, and the debasement of the dollar. It wasn't until recently in my life, we've had spurts of it going from, 1200 to 1800 or 1500 to 2000 over the last 20 years that I remember. But in reality, that's not a ton of change when you compare it to say the S&P 500 over those same time periods of those time periods. Now, right now, they are in parabolic booms. So a lot of the historic data is being skewed in favor of gold and silver, but I firmly believe that that's going to balance out, and that's why I'm at around 5% gold and silver. And now, I'm shifting my goal personally to get closer to 10%. So I want to be closer to 10% because, again, I have even less faith today than I did 20 years ago in the U.S. economy and the direction our country's going in, and how we're handling our money through the Federal Reserve and the IRS and all these, social benefit programs that are being, misused and misallocated. So anyway, I have less faith in the U.S. dollar than I ever did. So therefore, I am increasing my allocation from 5% to 10%, and I'm doing it primarily in gold because I want to have a collateralized object. So gold, I could go to a bank and say, hey, I have, 150, 200,000 of this tier one asset, and I'd like to take a loan against it, whatever, to go buy something else. Okay. Anyway, so if you look at this, our goal here with this subsidiary, like way down layer, is to find something that is going to ultimately increase way higher than the rate of inflation. Like, you're wanting a lot. You're wanting a lot of cash flow, or you're wanting, like, again, you're wanting to flip a property for 100%, or you want crypto to go up 1,000%, right? This is the weird category where I'm taking a lot more risk. I'm learning a lot more about niche markets. I'm spending a lot more time. And then also I do throw gold and silver in there because that's just the way I viewed it my entire life. I viewed it as that at a tertiary asset that was low on my list of needs. Now, again, some of you may flip this chart entirely upside down. You might say, hey, I want gold and silver as my number one thing, and then these rest of these crazy digital asset classes and stuff I don't trust, and therefore I don't. Again, every single person has a different mentality, and you gear plans towards those individuals. But I'm just telling you, this is what I would be doing, and this is why. And a lot of it has to do with these just simple, basic things. And as you keep growing and growing, all of a sudden, you look back, and now all of a sudden, let's say you've got 100,000 right in here, and you're still doing your 1,000, and maybe you have 25 years left, and maybe you're getting closer to 11% now. And you calculate again, and you look up, and all of a sudden you're like, oh, wow, okay, so if I do nothing, right, you're like, oh, okay, cool. If I do nothing for 25 years, except what I'm doing, all of a sudden I'm at 2.8 million. Well, guess what? Here's the fun part about this. When I do everything based on how I want to retire. So, like, let's say I want to retire, right? And I want to earn $100,000 a year in retirement. Now, we could talk about the Roth IRA and how if I can get to, like, say 2 million in a Roth IRA, well, all of a sudden that income and those capital gains are untaxed. So I could be living literally tax-free in retirement, besides like property taxes. But anyway, so let's think about this. Let's talk about some numbers now. So let's say I wanted $100,000 in retirement. Let's go up to like a bigger size. Right? If I wanted $100,000 in retirement per year, right? So I have to figure out, okay, I'd figure out like how much money is it gonna take to get me there, right? All right. So if I'm trying to figure out how much money it's gonna take to get me there, I can just kind of take. Let's say I want to withdraw 5%, right? And my goal is to like make it 5% of my money, right? So, and the reason I want to withdraw 5% or less is like historically, if I move my money from growth accounts to, let's say, a dividend account, income account, something like that, well then if let's say I'm making 5% to 6% on my income account and I'm spending 5%, well, that means my principal is basically staying the same. So if I have 2 million, I'm basically keeping 2 million. However, if I'm taking out 10%, right, and I'm only earning 5 to 6%, I'm losing 5% of my principal roughly per year. So eventually I'm going to deplete all of my nest egg. Now that may be fine for some people. Some people actually do a drawdown program in retirement to where they basically want to die with $0 and they want to live their fullest. That's fine. For me, I just kind of like, I like growing. I like my hoard like a dragon. I like it going up, right? So what we would do is I would take about 5%. So now I look at that, I'm like, okay, divided by 5 into 100. That means I need $2 million, right? I had $2 million. If I have $2 million and I withdraw 5% a year, I get $100,000. And so I just work this entire equation backwards. I go, okay, how do I get to $2 million? All right. Then that means, like, let's say I'm going to get average 9%. I'm putting $1,000 in. I started with 100. Hey, look at this. I'm a pretty good guesser, but okay. So you can play with the numbers and work it backwards. So let's say I had $25,000 invested. And again, if you have gold and silver, like, you can do the same thing with gold and silver. You just look at your average rate of return on gold and silver. And again, you can't bank on this stuff. It's just estimates. It's not guaranteed. But if you're getting, let's say you're growing 20% annually on gold, you just do the same thing. That would be amazing. Like, if we could average 20% in gold, that would be amazing, right? If you can average 5%, it's still pretty good. So let's say I had $25,000, and let's say I need to retire in 15 years. Okay. Um, if I do nothing, average rate of return, if I do nothing in 15 years, right? Nothing what happens. That 25,000 becomes 91,000. That's not nearly enough to get me to that 2 million mark. Let's say I go and I do $1,500 a month investments. Okay, I'm at 619. See how important time is? How important time is to this equation? That's why I try to teach the youngest people I can to start early. Look, now nothing's changing other than the amount that I'm investing. I have 25,000 to start. I'm putting 3,500 a month into this account. That is, again, it could be gold, silver, mutual funds. It doesn't matter. Invest stocks. It doesn't matter. We're talking about just rate of return. I'm getting 9% back for 15 years. Right? Right. That's crazy, man. It's really hard to start late. I get it. We have to be putting in. That's probably 5250. All right. So look, we're at 2 million. So now I have a plan. Okay. This plan sucks and it's frustrating, but I have a plan, right? I know that if I only have $25,000 and I only have 15 years till I retire, I need to put in, and I'm going to average 9%. I need to put in $5,250 a month just to get my number. Now, you make adjustments, whatever. But most people are probably not in this situation. Most people that probably only have 25,000 are probably people that more like have 30 years or more. And then all of a sudden, if you do the same numbers with 30 years, like, right, if you can manage that for 30 years, look at the difference, right? So for 30 years, you're probably only need like $1,500 to do this, to get to 2 million. Did I lose all of you yet? You don't even need that much. Okay. So again, the key here is having a plan early, executing it early. And I think the problem that most people face is they never had a plan. They just spent what they earned. They threw it out there. Make money, spend money. Make money, spend money. Take out credit cards, take out debt. Because why? Because I need the new Silverado, or I need to go to Europe for a month because that's what my friends did on Facebook, or whatever it is. We blow our money, or my wife needs that new Gucci bag, right? Most people blow everything that they spend. They don't save. That's why I think that, like, as boring as this chart right here looks, the thing is, for me, if you just follow it, and I'm going to tell you, frankly, I followed this. This is what I did. And I broke, right? I broke out of that system. I broke out of the system to the point where, like, I can work now because I choose to work, if that makes sense. Because I want to work. I want to keep earning income. Because by earning income, I can keep increasing these numbers. I can keep increasing my contributions. You will get to the point. Like, if you just follow a very simple structure, you have a plan, I believe personally that you will always get there if you know exactly where you're trying to go. And you just make the sacrifices to get there. And it is a long, slow, boring plan. Other people might go to Vegas for a year and they might be great gamblers, and all of a sudden they come out with their 2 million and they're done in a couple years. I don't care, man. I don't care how anybody does what they do. Again, if somebody wanted me to sit down with them and explain kind of the most boring, basic way to probably achieve financial freedom for themselves in retirement, these are the things that I would probably teach. So quick recap is 1, earn an income. 2, set a budget and make sure that your expenses are less than your income so that you have money left over at the end of the month to do something with it. 3, build up your emergency savings account. Why do you do that? You build up emergency savings accounts so that these investments down here that take, oops, what's the wrong thing? Sorry. These investments down here that take much longer to grow, that need a much longer time horizon to grow and reap the fruits that you sow, right? You don't want to be taking from these every time you have a problem. You want to be taking from these up top. So that's why you build those up, so that they can protect the more volatile, riskier investments. There's nothing worse than being forced, right, to take money out of an investment before it has had a chance to go up to that, market cycle to where it is now more valuable and in higher demand, right? There's nothing worse than that. Like, it's like your primary residence, right? Like, you don't want to sell at the bottom of the market, right? If you have to sell, you want to sell at the top of the market. Well, you know how you prevent yourself from having to be forced to sell when you don't want to? You build up those other accounts that protect your wealth. That's why these are so important to me at the top. They are long, slow, boring processes, but once you have them, they protect you from making stupid mistakes or getting timed out of the market. The number one thing that you're going to hear lower income or poor people say is that they knew exactly what to do. They'll say, oh man, I knew that was going to, that stock was going to boom or whatever, that crypto was going to boom or that business was going to do amazing. Oh man, I sold too soon. Or they say, I couldn't get in, when it was at its low. That's because the reason that they always have these same sob stories is because they didn't take care of the first part first of living below your means and building up your nest egg prior to worrying about getting into those things. Then when you've built those up, you can literally throw your money at anything and you can keep it there until it gets to the point where you want to sell it or not. Anyway, I hope the 6 people that probably stayed for that demonstration enjoyed it. It's not glamorous. It's not exciting. You want to know why people don't talk about real financial advice on YouTube? What people want to hear is people want people to say is, oh guys, look at, I actually did say this, but like, look at the chart of oil. Oil is at 20-year lows at $53 a barrel. It's basically rhymed going up. Everybody should go and put $500,000 in oil futures contracts that are going to expire in 6 months and just pray. I guarantee you it's going to go up, right? That's what people want to hear, but that's not real. That's not life. That's not real life. That's not real financial advice. That's just speculative, like guessing. If you want to do that with the money left over after you've taken care of all of your nest egg assets that are important, do whatever you want to do. But I would never in my mind say to somebody who just has a wad of cash and doesn't have anything else built up to just go throw it into one thing and pray, even if I firmly believed that it would be, a true story, that it's, even if I believed it was guaranteed, I wouldn't want them to do that, because that 1% chance that it ruins their life isn't worth it to make the recommendation. So anyway, those of you who are out there that ever wonder why people, I think, that actually know what they're doing and actually know how to build wealth and actually know how to save money and invest money, the reason they don't give you advice is because they don't know you. They don't know your situation. They don't know your risk tolerances, your family goals, your life goals, they don't know anything about you. So they can't tell you what to do. I love you. God bless you. I hope you have a wonderful, fantastic life. I hope you find prosperity and wealth in everything that you do. This will guarantee be the lowest watched video I've ever made in my life. And enjoy it. Peace out.